Hi CA students, let's revise CFN and AFM Chapter 13 Business Valuation. Practical question 8. Following information is given in respect of WXY Limited, which is expected to grow at a rate of 20% per annum for the next 3 years, after which the growth rate will stabilize at 8% per annum, normal level in perpetuity. Due on the revenue and cost of goods sold for the year ended 31st March 2014 is given, and operating expense, capital expenditure, depreciation, which is already included in the operating expenses amounting to 600 crores. During high growth period, EBIT will grow at 20%. Capital expenditure net of depreciation will grow at 15%. From year 4, normal growth period, revenues and EBIT will grow at 8% per annum. Incremental capital expenditure will be offset by depreciation. During both high growth and normal growth period, net working capital requirement will be 25% of revenue, and weighted average cost of capital is given, which is 15%. Corporate income tax is given 30%. Estimate the value of WXY Limited using free cash flow to firm and weighted average cost of capital methodology. Okay, here first we have to figure out the free cash flow to firm for the 3 years. Because from 4th year the normal growth rate starts. So for up to until 3 years there are different growth rates and different for EBIT and capital expenditures, and then from 4th year it will stabilize. So from 4th year onwards we have to find out the terminal value. Then for 3 years we need to calculate the free cash flow to firm, then discounting it with the weighted average cost of capital will give us the value of firm. So going to the solution, free cash flow to firm, the formula will be profit after tax minus capital expenditure changes minus increase in working capital changes. Now this free cash flow to firm is nothing but the cash which is available to the invested capital by equity shareholders and debt shareholders. How much is free cash available to distribute to them? So for that we need PAT first, profit after tax. Then we will be reducing capital expenditure changes, and then we will be reducing working capital changes. This will give us the free cash that is available to equity and debenture holders. So we have the base which is for the year ended 31st March 2014, wherein revenue is given, and then COGS is given, and then operating expenses are given, then depreciation, and then capital expenditure and depreciation is given. Now from the base year we are going to project for the 3 years, because base is like the at the end of year 0, we want year 1, year 2, year 3, then from year 4 onwards, which is the terminal value we are going to find out, because it is stabilized at 8%. Now 7500 plus the 20% growth will give us 9000. Then COGS also they told we can find out the EBIT based on these values. So for EBIT, the revenue minus, so operating expenses are reduced, and then depreciation is added back to arrive at the EBIT. There are two ways of doing this. One is, first we'll see how they calculated this 1980. This is nothing but the operating expenses of the base year. So this 2250, since they told it is already including depreciation, minus 600 will give us 1650, then plus 20%, because the growth rate is 20%, will give us this 1980. So this is one way of doing it, because since free cash flow to firm is excluding the non-cash items, so they first excluded the depreciation from here, and then they tried adding the depreciation back to prove that it is a free cash flow, then they arrived at that EBIT. This is one way. Or we can directly do, instead of doing all these things, we can directly add 20% to this operating expenses, which will give us 2700. We can directly consider this as the EBIT because depreciation is indirectly included, but we have to do as per ICAI how they have solved it, because we need to show that this EBIT what we have calculated is non-cash adjusted EBIT. So that's why we have added this depreciation back. So first we have removed the depreciation from operating expenses, then added back the depreciation, then tax rate at 30% is calculated on the debita, then earnings after tax, which is nothing but our PAT, then capex changes is nothing but capital expenditure minus depreciation. So here also there are two ways of doing it. One is adding 20 percentage to each. Okay, sorry, it's 15 percentage growth, so 15 percentage to each, and then finding out the difference, or whatever difference between these two, which is nothing but the capex changes. So 150 here, add 15 percentage to it, will get 172.5, then again 15 percentage 198.38, then again 15 percentage 228.13 for the third year. So like this we can calculate. Then working capital changes, um, they have told net working capital requirement will be 25% of revenue. So net working capital requirement will be 25% of revenue. Okay, so that can be calculated by the first, whatever changes to revenue will be the changes to working capital also. For free cash flow to form, we need increase in working capital only. So here 7500, it has increased to 9000. So 9000 minus 7500, which is nothing but 2500, multiplied by, they told 25 percentage. So 2500 multiplied by 25 percentage is 625. Sorry, there is a miscalculation here. So 9000 minus 7500 is 1500, multiplied by 25 percentage is 1500 multiplied by 25 percentage is 375. Yeah, so this way we can find out the increase in working capital. Same way from 10,800 to, so from 9,000 it has increased to 10,800. So difference between these two is 1,800, correct? No, 10,800 minus 9,000, 1,800 multiplied by 25 percentage is 450. Same way the difference between these two and then multiplied by 25 percentage will give us the working capital changes. Now as per the formula, 1890 minus capex changes nothing but 172.5 minus 375 will give us free cash flow to firm. So free cash flow for second year is 1619.62. The calculations are same. For terminal year it is 2680.13, and they told that specifically from fourth year normal growth rate EBIT at 8%. So here whatever we have calculated plus 8% will be for this revenue and all those things, and then for incremental capex set off by the depreciation, so there will not be any capex changes. Working capital as usual, it is during both high growth and normal growth, net working capital will be 25%. So here also the same calculation, there won't be any change in this increase in working capital. Okay, now since we got this free cash flows to firm, we can discount it with the weighted average cost of capital, then we can arrive at the present value for all these 3 years, and we need to calculate this terminal cash flow, because this terminal cash flow every year we are going to get this 2680.13 throughout the project period. So this divided by KE minus KG G. So the formula will be FCFF divided by KE minus G will give us the terminal cash flow, and this terminal cash flow is at the end of third year, hence we have to discount it by 3 years present value factor, which is nothing but, since we 2680 divided by 0.07 is nothing but 38,285.7, and we know that at the end of third year the discount factor is 0.6575, multiplying by that we'll get 25,172.8. Adding that 3,676.44, so the total will be 28,849.29. so this will be the value of WXY limited. That's it. Thank you.